Hi, Hunter Hastings here. We don't talk much at the Value Creators about economic policy. That's because we wish there was no such thing as economic policy. We wish that entrepreneurs and their businesses and markets were free to innovate and create new value for customers, which is what they do best. But economic policy does exist, so entrepreneurs live with it and treat it as part of their environment. But what if even that level of freedom is denied to us? Today we have with us Jeremy Vesta, an old friend, a top-notch Austrian economist who has operating experience at the entrepreneurial level with new healthcare businesses like Curali, where he's the chief operating officer. And he's also a managing director of Vesta Holdings, a comprehensively innovative new business company that includes businesses like beef production.
This is the Value Creators Podcast, your source for a new kind of business education, escaping from business administration mode and entering dynamic entrepreneurship mode. We're guided by entrepreneurial economics, which is the source of all growth and positive change for businesses of all sizes in all markets. We talk to experienced experts in value creation so that there's business learning for you in every episode.
Jeremy, welcome back to the Value Creators Podcast.
Yeah, it's great to be here, Hunter.
Well, you helped us a lot last time in understanding business relationships and their role in the economy at both the individual firm and the industry level. Today, we're talking about something different, and you're an entrepreneur, an investor, a business operator, a senior executive, lots of firsthand knowledge and experience, and you are thinking about the impact of economic policy chaos. So let's start
strange,
by policy chaos.
Yeah, sure. So in my mind, I mean, again, there's always chaos, but when you're talking about economic policy, it's things that happen abruptly that dramatically alter the market scope and what's going on, the rules of the game, or certainly interactions. But ideally, it's something that continues to be changed on a frequent basis, right? So certainly one policy going into place that's very disruptive is chaotic, but not as chaotic as a series of those changes, especially if they kind of counterbalance. So like one's removing, one's putting it back on, one's removing it. And I can't imagine what we'd possibly be alluding to there, but that type of style, which again, you can hearken back to the FDR days, right? During the Great Depression, the type of, if we can't fix it, if this doesn't work, we're just going to try something else. That kind of attitude is what I'm talking about when I'm talking about policy chaos.
Okay, good. So that's certainly changeable, and there are lots of unpredicted impacts. Let's take it down to a practical example for you as an entrepreneur. How do you see that, either in planning or execution or running your business? Tell us how it impacts you.
Sure. So it just creates greater uncertainty, and from an economic theory perspective, when you have greater uncertainty, that implies greater risk. Greater risk implies greater cost of on aggregate all investments, right? That's kind of the way I think about it. So it's not that all investments will be harmed, but certainly when you're looking at the aggregate of all potential investments in an economy at the time, if it was ceteris paribus, they now all incur on average a greater cost because there's something that might be taken away, or there's the emotional concept that there's an unknown out there. There's the next shoe that's going to drop might destroy what I'm doing. And so really what you're saying is that the entrepreneur is going to really demand a much higher, however he perceives that cost, that risk, a much higher bar for an ROI before they're ever going to put a dollar down. I mean, not only the sure deals, which are now not necessarily sure deals, are going to get invested in. And what you see is investment shrinks, people pull back. They might twilight something and say, indefinitely we're gonna pull the plug on this project until we know more, until we see some stability, and then we can re-engage. And if they never see stability, that investment's never happening.
So I could think of three costs in that vein, Jeremy. One would be a time cost. You
Yeah.
might just wait longer. One would be an actual money cost, as you say, the market rate of capital goes up, or it could be an opportunity cost. Hey, I'm not going to do this because I can see something safer. Or do you differentiate between all those? Do they all apply?
I think they all apply, and you could even add in almost a market efficiency cost where you're getting an outcome that is differing from either a freer market opportunity or, again, the ceteris paribus. So now you're getting different investments, which you can, as an Austrian, you could basically always say that's always going to be less desirable than what the market would have generated. So you can imply that there's some kind of consumer or market loss there than the alternative. Not that we can ever prove the negative, but I think all of those apply. The opportunity costs for the overall economy, certainly from the entrepreneur's perspective, there was something where in the other alternative, there was a money-making opportunity. There was value that was going to be presented to the consumer. There was going to be something new, something better, something cheaper, something. And that's gone. Obviously, the time preference is a huge deal because now I have to either wait longer to invest it. I might have to wait longer to see results. All sorts of time components come into play. And the monetary cost that's usually the initial kick in the boot, which is your current operation you thought was functioning now has an externality that just came in and disrupted everything.
So the first place we tend to look as Austrians, Jeremy, is probably capital investment. The economy grows as we accumulate capital, especially in new combinations, what the professors call heterogeneous capital. Is that going to be the most impacted, the capital investment that grows the economy? Is that the problem?
I think it goes hand in hand. I think it's capital investment and it's the current operating. If you have a current operating business, certainly the capital that's been invested could be all lost depending on how dramatic the move is. But obviously, there's going to be a lower accumulation of capital. You've just said it. When the cost of something goes up, and we're saying that policy chaos increases the cost of all investments, you're going to get less of it, which means you are investing in less capital. There's less opportunity to produce capital, to grow capital, to do these things, to grow further. It's the compounding effect that if you've impacted this investment, you've also impacted that entrepreneur's future ability to grow other businesses as well, because those resources aren't there.
Have you seen that in any of your businesses or any close by businesses that in terms of don't buy that truck yet, don't upgrade that machine, don't
100%. I think it's not a great time in the beef industry anyway, but I think you're seeing capex go to almost zero across the industry, even amongst the profitable side. So let's say you're a cow-calf operator who's now making a lot of money because the herd is so small, which is also as a result of a previous policy chaos issue, which was COVID. Shutting down in COVID created a massive disruption to the cattle industry. Well, they're still uncertain, even from back in that time, that do I invest and grow my herd, my operation, that buy that next property, do those things, because I'm just not certain what the beef industry is going to look like under tariff situations, under trade negotiations, under these things, because we could very quickly, the U.S. could end up with a very domesticated industry that really only has access to a few places untariffed, and therefore you've restricted the options to sell. Well, that's gonna reduce the profitability, decrease the margins, increase the level of competition in that area. And so, for that ancillary, that feeder business into that, the resource production, they're not going to reach out and do that next investment. And we're seeing it on the Packer side as well. There are projects that were slated that are not happening. I think you can see that a lot of places. It's really stifled the thought that I need to do the next thing. It's just I need to survive today.
Yeah. Yeah, that's clearly a strong impact. But I get the implication, though, it's also going to affect the short term and pricing, not introducing that
Yes.
new product, those kinds of things. So both short term and long term, is that right?
Yeah, I mean, for instance, we're up in Canada, and that's where our plant is. And when the initial tariff went on, and it only went on for a day, and it basically upended all of USMCA, right? When that went on, you saw the price of cattle drop precipitously because they all of a sudden they didn't have the ability to send cattle south to be produced, to be slaughtered and fabricated. And then in Canada, obviously, there's fewer slots, more cattle availability, reduces the price. On the other side, there's less availability to the finished product. So it was actually, for a short time, it was going to increase margins in the beef industry, but at the cost of really hurting the consumer, driving further inflation, and hurting the producers on the other side, the feeders and the cow calf, which eventually, just like what happened in COVID, creates this market disruption, which creates these bigger cycles, creates these high profits and then high losses, and high profits and high losses, and it creates a long-term environment beyond just the short term that becomes almost unpredictable and very difficult to make even future investments after stability is regained.
And then if we're in the world of investment, we're also in the world of interest rates.
Yeah.
And there certainly does appear to be some chaos there. And you know more about this than I do, but the chaos seems to be all over the spectrum. The short term rates are higher than the president wants them. The long term rates are making it really hard to pay off the debt. And then the 10-year is tied to mortgages, and I presume to a lot of business loans, and that's uncertain. So that's a mess too, isn't it?
Yeah, I mean, the vast majority of business loans, I mean, you think about mortgages, at least in the US, a lot of people have 30-year fixed, right? Or 10-year or 20-year fixed rates. And to the extent that they don't have to move, they're okay. Now, if they lose their job and they have to move someplace else, that's where the chaos ensues, because now I've got to refinance at a higher rate. But business loans, by and large, are not fixed or are shorter term fixed, where you can do certain periods. But a lot of those, especially in smaller businesses, those are floating rates. And so as these moves happen, especially in operating lines of credit, for example, the cost of doing business literally just went up, because now you're paying more interest to the banks, because again, there's more risk in the term over which they're pricing, which is why you'd have an inverted market, right? Everybody's believing long term you might overturn these policies, you're going to get a different party in, you're going to do different things, so we're going to return to stability at some point. But right now, for this time frame, there's very high risk, and so banks are going to price that in, and they're going to price even higher risk over and above necessarily where the riskless rates go. So it's going to increase at a faster rate, and that puts pressure on businesses. Now, when you're looking at your weekly P&L, what you thought your cost structure is no longer what your cost structure is. And to the extent that you're indebted, which could be a benefit, you might have taken on a lot of risk in terms of debt for an ROI that at the time appeared very, very large. But you could have had two things happen. You could have a tariff come on, or a policy that comes on and makes your investment less profitable at the same time that your debt becomes more costly. And so now you're getting a double-edged sword, and it might deep six everything. So, the market is clearly pricing the chaos in. It's clearly pricing the risk in. And it's got a timeline where it believes the chaos will be reduced. But again, if that doesn't show up, then you're going to eventually impact long-term rates if they find that the chaos can't be controlled and can't be stabilized.
And it sounds like that's harder on small business than on medium-sized businesses than large businesses, where they can take that 25-year long-term ROI, long-term cost of capital is going to be 6% forever. But that's not true at the short end, and not true if you're a smaller business, right?
Yeah, the zombie corporations, they can keep surviving, right? When you're a large public company and you can raise capital, and there's a sense of less risk, and there's less information known about you relative to the people that are lending because they're everyday investors who are speculating. To the extent that the market's going up and you're able to raise that capital, you're able to sell your bonds, all of those things, they're far less impacted for sure. To the extent the policy doesn't directly impact them, which some of them do. Some of them do. But when you look at that and you look at the small entrepreneur, they're able to be a little bit more flexible. So there's a small benefit there. But yeah, as far as cost of capital, there's far less markets and there's far less options.
But we always talk, Jeremy, about entrepreneurs and entrepreneurial businesses as being, as you say, more agile. We talk about uncertainty as an opportunity. They should be better at navigating those kinds of uncertainties. That's an advantage. But maybe this kind of uncertainty is different, right? It's a little bit heavier weight.
I think it's degrees, right? Because you
Mhm.
always have a certain failure rate in entrepreneurship, right? So now you're taking a certain segment statistically of that population that would have been successful, now are not going to be. So
Mhm.
you've increased the uncertainty, you've increased the probability of failure. So as a rule, the expected number of failures are going to go up. Well, that, to like we were just talking about, long-term impacts, that's capital creation, that's emotional creation. I mean, you talk about non-monetary utility, the the life impact on those individuals and their ability to overcome the failure and go on to do bigger and better things and use that brain and use that fervor, that could be stifled as well. Whereas if they had some success, they can build on it and generate more for the economy later on. But I think just naturally, there's going to be more failures in any given population when you increase the uncertainty like that. It's not that there aren't entrepreneurs that can't overcome it. There will be some, but there will be less.
Well, I was going to go there. Is there a reward function as well? That there are some businesses or some opportunities or some individuals who can make hay out of this chaos? Is that possible?
Absolutely. I mean, it's a crass saying, but it's like in every pile of horse manure, there's a pony, right? You can always find the creative solution. You can always find an opportunity when there's increased risk, increased burdens, increased issues, right? If you're creative enough to find the way to navigate it and get through. That said, it definitely picks winners and losers because it's now increasing that risk. It's telling a certain percentage more statistically that they are going to fail. And like we talked about, it's giving a better environment to the less entrepreneurial, large, I call them zombie corporations that have just existed since, what seems to be the beginning of time. So it's actually further concentrating markets. It's further generating, that market, uh, the market share gets further concentrated, right? And further concentrated and further concentrated because those companies have access to the capital. They can survive it. They can keep going even when costs are higher, even when margins are squeezed, even when things are tough. So at some point, you've squeezed out most of the entrepreneurs.
That's an interesting point I hadn't thought of. So concentration, market concentration, is liable to increase in times of policy chaos.
I
That's
would
a
think so, yeah.
interesting thought. I was thinking more of the opportunity for the law firms who can navigate this chaos, the compliance software companies who can build it into their
Oh, for
software, the
sure.
supply chain managers who paid to sort it out. So there are maybe the wrong kinds of businesses, but they're on the fringe where they can benefit
And
from
I
this.
And I think you hit on something there, the wrong kind of businesses. I think in true Austrian sense, you would say in the freest market possible, there are industries that wouldn't exist. You look at tax preparation, right, for income taxes. If you
Mhm.
truly had a flat income tax or no income tax or however you want to do it, there would be hundreds of thousands of individuals that would be out of work because we've generated an industry around something that was a government policy. To the extent that you continue to create policy chaos, you're going to get more of those industries that, again, they're not non-productive. They are producing something, but was that the most efficient application of capital in a free market? No, you could argue the alternative from an Austrian perspective would be not having those regulations and those barriers frees you up to invest in things that produce more utility, more gain for the overall economy and the consumer.
Yeah, it's one of the things Murray Rothbard would call malinvestment, right?
Absolutely.
Well, let's switch to the other side, Jeremy, and talk about consumers. You've and customers, business customers. You've implied that there's a cost burden thing that's going to impact pricing negatively. Maybe missed innovations. You're not going to get innovation as fast. But put your customer glasses on here and look through that lens. What's the problem for customers?
Yeah, for customers, you don't know what your prices and what things are going to be there. So, to a certain extent, you might overconsume. So, I'm going to rush out, and you're seeing that a lot with businesses and with consumers. I'm going to rush out and consume now. I'm going to import everything I can because I don't know what's going to get done and I don't know what the future holds. So, I need to do it now while at least I know what it is today because it could be worse. And then you're going to get delayed consumption where they say, boy, I can't pull the trigger on that thing. I'm just going to kind of hold my cash
Mm-hmm.
and I'm not going to go and spend because I don't know what tomorrow brings. For certain parts of the population, they're going to become extremely risk averse and just become perpetual savers, which, as you know, that's not phenomenal for an economy. You kind of need consumer spending. That's kind of what we're all here for. Is it's at the end of the day, somebody's got to buy our product, and if that decreases, again, now you're losing further. I think it's a very good point you're making. You're losing further investment capital fuel because you're reducing revenues of companies, you're reducing the sales, you're reducing their projections. And so it looks even riskier as time goes on, even if policy now stays the same for a while, until you can coax those individuals to say, no, things are strong, things are stable, I'm going to re-engage in the economy again. But now you've got a lag. You've got that gap. And that gap can be just as painful for companies as if they just overall had reduced revenues.
Yeah, it's the end of July as we're talking, and there was an article in the Wall Street Journal, I think today, about Procter and Gamble and the consumer staples industry, and they said the consumer is under stress was the term that the CFO used. They're holding back, and he implied this for the very reason you're talking about. They're unsure. They're not underwater. It's not terrible, but they're just unsure, uneasiness, as Mises would call it, and so they're holding back. So he warned of some lower activity in the future.
It's 100% correct. Absolutely.
So before we started this conversation, we were talking about some of the basic principles of things like tariffs. It's a tax.
It is a tax. Yes, absolutely. And guess who pays the tax?
Yeah, exactly. Just
The
just
consumer.
build on that for the audience, Jeremy. The policy chaos as a tax on business. Unpack that a
Yeah,
little.
it's the concept of the incidence of a tax, right? If you do anything, I mean, any regulation, any tariff, subsidy, anything acts as a tax in some way. It's creating a market disruption. It is raising costs to certain individuals. So no matter what happens, it's a tax. And in this case, again, you're taxing, for example, I mean, one of the funniest things I saw recently was a report talking about, Toyota technically can come out of this situation with a comparative advantage in cost over American producers because even though they might get taxed the 15% tariff rate, they're not getting taxed on all of the other intermediary pieces that are getting put into the car. So at the end of the day, the effective tax rate, the effective tariff rate on, say, a GM car coming out of the United States factory is now higher cost than Toyota. And I don't think that was necessarily the intention of the administration when they set about this whole process. So now you could technically have more imports from Japan and less cars produced in the United States. So it's fascinating how this all works, and this concept that a foreign country is going to pay the tariff. That no, the tariff and the tax always ends up hitting the end user. Yeah. That's where it lands. I mean, that's just. I think both sides agree. You know, you could be a Keynesian and still understand that. Yeah. It's just reality. So when you place a tariff, you can't assume that it generates a positive impact on your economy. It's raising the cost of goods for your consumers. It's generating less growth, less impact, less innovation, less capital investment, everything, and slowing your economy. So that other than that, it's a great idea.
We're delighted to announce the Value Creators online course. For entrepreneurs in every kind of business, big, small, or medium, at every stage, in every industry, our course provides the foundations and principles on which to build success. Simple, clear purpose and principles give rise to creativity, innovation, and competitively superior business action. There are 11 foundational principles or mental models that together cohere into the value business model. Principles for value generation, principles for value operations, principles for value finance and accounting, and principles for value sustainability, as well as the new knowledge accumulation you'll need for continuous innovation. These principles are delivered by top business professors from top business schools: Mark Packard, Per Byland, Gordon Miller, David Rapp, and Bart Vanderhagen. You'll find video lessons from them, along with downloadable tools, processes, and other valuable content. Master these lessons, and you'll master the most important skill in business: value creation. Go to thevaluecreators.com and click the course link. Well, this idea of chaos, I'm warming to it very much. So tax codes, by definition, are chaos, right?
Sure.
As you say, the exceptions, where the incidence hits, the built-in inflation, the exceptions that hit some companies and not others. I mean, the whole thing is chaos. So maybe one place to get rid of our chaos is a flat tax. Certainly a zero capital gains tax would be a good place to start.
Sure.
Is that the definition of chaos, is the tax code?
Well, I mean, it can be, but I mean, think about if you did it overnight, right? As opposed to if you gave people a 3 to 4 year twilight period, right? So if you eliminated the IRS tomorrow, went to a flat tax, and it all became simple, look at the hundreds and hundreds of thousands of people that are out of work immediately. Do you really want your economy to have to go through it? Certainly politically, that's totally unsaleable. Mm-hmm. Right? You're seeing a similar thing with, from our industry's perspective, with illegal immigration and some of those policies the administration have. They're good policies in order to control your borders. Those are your intellectual property as your country is those things you have to protect. However, doing it in such a chaotic manner and as quickly as you do it, it has a very unintended consequences, because those businesses have been operating under the stability of the old policy. So what I'd argue is sometimes you can have a bad policy, but have that be more economically viable in the short run because it's stable and the game and the rules are known and we can adapt to those. Whereas if you start eliminating things in a very quick and arbitrary manner, now businesses have to shift. If you're a tax preparer and you know that, tomorrow, basically your job's gone because there's no withholdings, mm-hmm. there's no loopholes, there's no itemized deductions, all of that's going away. What do you do tomorrow for work? well, now you're in the unemployment line. And again, it'll filter out. The market will find uses for you, maybe not at the same salary. Maybe you'll switch to a different industry and things like that. But it alters the winners and losers. Whereas in my opinion, if we can plan on a longer timeline and we can telegraph what policies we want, and there's twilight periods and we give people time to adapt, then you're more likely to have less economic disruption, more ability to react, and the ability to get out of tax preparation. Hey, there's going to need to be some, but maybe I start doing it on the side, and maybe we start to do some different things here, and I'm going to invest more and I'm going to spend less and save for those time periods because I don't know where I'm going to work.
Yeah, so you're differentiating, I think, Jeremy, between the chaos of policy, how the regulations and
Right.
the laws are written, and then the chaos in implementation, which could be
Mm-hmm.
entirely different. So it makes me think about Gary Gensler back in the old administration at the SEC, which was regulation by lawfare, right? We don't know
Yeah.
which regulations we're violating until we get sued for it. So maybe maybe the administration is guilty on two fronts, right? The actual policy chaos and the implementation chaos.
Yeah, 100% agree. I mean, it's there. There are wiser ways of going about some things that could be positive. And obviously, we know tariffs are never going to be positive. It's been proven out that the U.S. over the last century. I mean, the last time we're talking about tariffs was Smoot-Hawley. And ever since then, the U.S. has benefited from being freer in trade than all of our counterparts.
Mm-hmm.
It's not been the other way around, and we've all seen the chart that shows that American manufacturing was eroding long before we ever got into the current situation we're in terms of trade deficits. And you can argue that's just an accounting mechanism anyway, and doesn't necessarily mean a whole lot about your future growth and where your country's
Mm-hmm.
heading. But this implementation chaos, all of these things, there's a wise way to go about it. And the best thing that we've learned as Austrians is the more we can take our hands off, the better. And unfortunately, that does sometimes lead to some things remaining in place a lot longer than you'd expect, because the removal of them creates such disruption that your economy might go through something serious. Certainly, again, a flat tax, you'd have to have unbelievable growth to overcome the level of unemployment I think you'd generate at the beginning. And that's something we'd have to consider.
The Austrian theory is that the bust is the necessary adjustment that takes the market back to balance and homeostasis. It's not easy to keep hands off, but that's the right thing to do. And
Yeah.
so,
And I agree with you. It is 100% the right thing to do. Um, my only caveat is we haven't kept our hands off for
right,
hundreds of years. So,
right.
when you're talking about building bubbles, we build some pretty big ones. And it's whatever we're willing to take. And then I think there's political costs you have to take into consideration too. But I think everybody could be sold on implementation of policies over a longer timeline in a more appreciated approach, because again, lives are at stake. It's not just you got to deal with the human costs as well that come along the way. And obviously that happens on both sides. The policy chaos you're talking about, every time you implement a regulation, it's going to impact people. It's going to kill industries. It's going to kill innovation. It's going to create market concentration and in bigger companies that do less innovation. We all know those things are bad. We all know that a flat tax would be absolutely brilliant. It's just a question of how to get there in an appropriate manner, I think.
Well, let's go there.
Sure.
We're allowed to think. So, how do we get there? Is it so? One option we could think about is write fewer regulations and be more thoughtful about them. The other is be more consistent in their implementation. The whole political system seems to be determined to do the opposite. Is there a way to get there?
Absolutely. I mean, I think you can see from periods in time where governments are able to do nothing. So let's say they have a divided government and nothing gets passed. those are pretty economically prosperous times in a lot of instances, because there's just nothing new coming down the pike. That at least in itself is initially a good. You're not necessarily eliminating anything, which would be great, but you're not increasing the complexity. You're not picking more winners and losers. You're not changing the rules. You're not doing anything overly negative. So that in itself is good. But obviously, we know, the economic multiplier on government spending is not high. In a lot of studies, it shows it as negative, right?
It's
So
negative, yeah, I'm in that camp.
it's a negative multiplier. So the less of that we can get, the better. And I do agree, as quickly as we can get to that is a good thing. So ideally, yeah, you want people removing regulations, but you can argue, compared to what we've experienced, say, in America for the last, at least 30, 40 years, not writing the next regulation would be a pretty darn good thing, because at least then we're not further debasing the wonderful product we have. We have a lot of entrepreneurship to the point. America is the home of most of the entrepreneurs. It comparatively has been a more fertile ground. And maybe that's part of the calculus here. The administration is saying, we've got so much we can sacrifice. But we know from an economic perspective, why would you do that? I never want to sacrifice because I can get more. It's got a compounding interest effect. I want to keep the environment as fertile as possible to keep growing to the next. And certainly, to the extent we remove regulations, make things easier, allow the free market to work, we're going to have more of it and better.
Yeah, I was listening to the president the other day at the AI summit. I think that's what they called it. And he was talking about AI as a great future multiplier. There's going to be great economic growth out of this. We want America to be number one. We want there to be proper regulation, but it's got to be clear. It's got to be at the federal level, so there's not 50 different states regulating AI. He seemed like he was making exactly your point, that we want to properly regulate this area, but then turn the entrepreneurs loose. And as you said, we've got great entrepreneurs, great inventors. America's going to lead in this area. So was he doing the right thing there?
Well, I think you could say no regulation is the appropriate regulation, and let the market bear out the forces, and not stifle any creativity in that regard, because somebody's gonna figure it out somewhere. Mm-hmm. If you're not allowed to, somebody is going to be the winner in that field. Certainly I'm not a Luddite. I'm not going to sit here and say that, it's going to take jobs and obviously there's going to be market disruption created by AI, and we're seeing that, but ultimately that's positive. That's the creative disruption that Reagan talked about. It's the thing that leads to the next capital investment. It allows human capital to be applied to places that we don't even know it's going to be applied to in the future. It's the industries we can't think of, we can't conceptualize right now, but they will exist. So I do agree. Hey, let the entrepreneurs run and do those things, but the idea that we're going to initially start and begin by regulating it, again, you're saying that a group of individuals is going to have the forethought and knowledge to know explicitly what all of the unintended consequences are, have thought through everything, and create an environment that's going to be productive. And I'm not arrogant enough to think that I've got that. I certainly don't want to be the regulator with the task of trying to figure out, with something that people barely understand on average to begin with, that we're going to know how to regulate and control this industry in a perfect manner. And I'd argue we already do know the perfect way to regulate it. Let it run free.
Yeah, let it run. Yeah. Well, you make a good point. So on the other side of that, in our system, there's people lobbying for policy chaos, right? Lockheed Martin's lobbying for war, and Palantir's lobbying for similar activities, and I'm sure Booz Allen is lobbying for more tax code line items, and so some businesses are lobbying in favor of that. Is that fair?
Absolutely. Anytime somebody benefits from a further market concentration, and wants to remove competition because maybe they're not able to come up with those ideas. Maybe they don't have the structure. Again, as we talk about, I think we talked about in the last podcast, the decreasing returns to scale. You have increasing returns to scale, but once you get on the other side of that curve, people become unmanageable. Now you're managing more like a federal government instead of understanding the core issues at the low levels of your employees. You get this chaos. You have to have standardization where you used to have free thought. It becomes more difficult at those sides. So they have to lobby. They're trying to survive. They have to lobby for the regulations that make it more viable for the large company than for the upstarts. So naturally, they're gonna lobby, but you don't see a lot of small to medium-sized entrepreneurial firms lobbying the government. They're too busy running their businesses rather than trying to get policies that help make them the winners, and they don't have access to that type of capital, more or less.
Right. Yeah. Now, a lot of our lobbyists are the entrepreneurial businesses of yesterday, the Googles and the Microsofts and so on. That now they've got Washington offices. So take us there, Jeremy, to the implications for the entrepreneurial ecosystem. We have this picture, I have this picture anyway, of America's, there's a few big businesses, but right there in the backbone, the vast majority of businesses, 99.9% of them, are not in the Fortune 500. They're not getting those decreasing returns to scale. There's a lot of competition that raises the best ones to the top. That's all the growth, all the job creation, and so on. Now we look at the Mag 7 and the massive accumulation of share, as you put it, in revenue and so on like that. I had always suspected in the digital age we get more of the entrepreneurial small and medium businesses thriving and less domination by the Mag 7. Maybe it's going in the other direction. What's your perspective?
Well, I think if we regulate it, we're certainly going to get that. But AI is an unbelievable equalizer. I mean, we have a healthcare business like we talked about before in our previous discussions, and I saw a report recently, I think it was in the Wall Street Journal, talking about the efficacy of AI diagnoses at the primary care level. And it was funny because you saw that the doctors actually did worse when they were applying AI rather than AI by itself was the most accurate in diagnosing. Doctors with AI were the least accurate in diagnosing because they were questioning the AI and saying, no, I don't think that. There was a bias against, no, I don't want to believe that machine can do it. And so I'm going to say no. But what it tells you is it frees up a lot of really smart and productive resources. So if you're a small company and you can't afford a marketing person per se, ChatGPT and some of these services can do a pretty remarkably good job if you're managing the prompts of developing your marketing script for you. We just generated one the other day for working with a union groups, what the types of things we would want to say if we were engaging a union group to make them feel like they can really trust and believe us, which of course they can. And it did a remarkable job. I mean, it's not perfect, but it's going to keep getting better. So you end up spending less money on these resources because you can now use the technology to take on parts of that work that you were probably was going to be completely missed in your organization prior because you just didn't have the size to afford that, which allows you to grow faster, allows you to invest that capital in projects and in human resources that are actually going to be part of your business and not in things that just feel like you have to cover your bases. Regulation. Think about regulation and compliance. I mean, my goodness, you can free up a lot of resources when you're not constantly having to go, as you were mentioning, to a legal firm that is going to spend, an articling student doing 5-6 hours looking into your answer when AI had it in 15 minutes and was actually a better response.
Are you finding that AI is sufficiently knowledgeable about regulations and everything that applies, say, in your healthcare business that you can you can rely on it to navigate that compliance?
Sure, I wouldn't rely on it just yet, but it is remarkably accurate. We certainly find some errors. You certainly don't want to just, hey, take it and print it. Let's just run. You want to check do some of the review at this stage, but it's going to keep getting better, and it's going to learn, and these systems will learn where to look for the resources, what's the most reliable resource, where are there less biases. I mean, certainly in the world of scientific research, I'd love to see some application of AI just in doing the peer reviews, because so many of these data sets are full of selection biases and things that really the researchers aren't picking up on, and they're putting forth research that they view as very rigorous, and their assumptions are wrong. And then 20 years later, we reverse it and we say, well, that was a waste of time, and we had a new diet fad or whatever that turned out to be inaccurate, and or we thought we knew something we didn't know. And you look at the resveratrol movement in the late 90s, early 2000s, and that turned out to be one study that it couldn't be reproduced, but it generated millions of dollars worth of investments and supplements and people spending their money on this stuff, and it turned out to do really no marginal benefit to them.
Yeah, the red wine is good for your movement, right?
Right, and AI could have saved us from all of that. It just didn't come soon enough.
So it sounds like maybe you're pointing to a solution, and I'm certainly enthusiastic about this. As AI gets more and more competent, we can automate the compliance. We can automate a lot of the bureaucracy. The rules will still be there, but perhaps there's less chaos because we can rely on this automation device, freeing us up, as you say, for more productive activities in terms of creativity and investment and innovation. Is that a positive view of the future of policy chaos?
I think so. I mean, can you imagine the CBO using an AI tool that they find to be effective to go through and audit their projections and audit their assumptions and compare it to past events, comparing it to Smoot-Hawley, comparing it to things like this to actually put forth what might really give us some better direction. We know all economic projections are inherently going to be wrong because you cannot predict the future. But to the extent that we can have a little more certainty, at least it can maybe tell a more objective. My hope would be AI would lead to us in policy being more objective, which will lead to more people saying, we need less regulation, we need less tax, we need less burden, and we need more people to be free rather than more control. So even though you're obviously, nobody in Congress has that incentive. They want to stay employed. They want to keep doing things. They want to keep selling. If you can get that message out to the population and educate them in a certain way, and do it in a way that AI drives you to really understand how it's going to best reach that individual, what's the best approach? What's the most researched psychological approach to embed this in the population? You could do some real good.
Well, let's wrap up with your advice then to the entrepreneurial part of the economy. Given all the chaos that we've surveyed and the issues that we've talked about, the potential positives of AI in the future, but we don't want people to despair. We want them to be
right,
enthusiastic, optimistic, and active. So, give us your advice.
I think logic is your greatest asset when you go through times of chaos. So obviously you want to think through all the implications of potential policies. You don't want to get scared. You want to think through what the opportunities and the costs may be. And I think this sounds really counterintuitive, but I think accepting that defeat is plausible is a liberating thing, because if you're in denial, if you have to make it work, you're going to be so crippled by fear, you're not going to move to the next step. But if you've accepted that, okay, this might not work, I might have to rebuild, that frees you up to just focus on the fight, because it can be a fight, and you focus on the day to day and you focus on the next best thing to do. And if you can just focus on the next best thing to do and tune everything out, knowing that at the end of the day, my efforts may be for naught, but that's okay, I think you'll find that a lot of people will be able to get through it and find solutions, think more clear with a clear mind, and figure out the way to navigate it. That's a good mindset for an entrepreneur, I think.
Yeah, the entrepreneurial mindset, as we keep talking about it, you've captured it very well. Well, let's wrap up there, Jeremy. Thank you so much. I wish you great success and less chaos.
Absolutely. Thank you so much, Hunter. Great being here.
This has been another episode of the Value Creators Podcast. Thanks for listening. You can visit thevaluecreators.com for links and resources related to this episode. And check hunterhastings.com for more content on entrepreneurial business management based on value creation principles.